First of all, I'd like to recap on the full year result. So using our preferred measure of profit, that's net profit after tax, excluding net movements in the fair value of financial instruments, the result for the year 269 million versus 167 last year. As Mark mentioned, that result was boosted by the proceeds on the sale of Decipher Trade, and the contribution of DCT is shown separately in this graph. If we remove DCT from the picture, then the underlying result from continuing operations was for a profit of 202 million against 161 million last year, an increase of 26%. In the rest of my presentation, I will focus on the performance of continuing operations only. So firstly, to look at the income statement in a little bit more detail. Revenue was up 17%, and that was driven by increases in transmission revenue, both for the AC network and also for the HVDC link. Our operating expenses were well contained. In total, they were up 2.4%. If you strip out costs that were not directly within our control, then controllable costs were up around 5.7%, and that's split between increases in staff costs, business support costs to support key regulatory asset management initiatives, and also the one-off costs of repairing one of the fibre optic cables under the Cook Strait. Those two factors together meant that EBITDA was up about 26% in the year. Depreciation rose 14%, and that's simply a function of the increasing investment in the grid. Finance costs up sharply 57% in the year, primarily a function, of course, of the higher levels of debt that we now have, partly to fund the grid. But the effect this year was accentuated by the fact that there was lower capitalised interest, with a number of projects reaching their commissioning stage. So overall, taking all those things together, you get a net profit after tax for continuing operations up 26% at 202 million. If we look at the net profit in a slightly different way, and as many of you will be aware, Transpower's revenue predominantly comes from its regulated transmission business. Around 90% currently of our revenue comes from transmission, predominantly regulated by the Commerce Commission. Most of the remainder comes from the system operator service, so we receive a fee from the Electricity Authority for providing that service. And while small in financial terms, of course, the system operators are essential and very important part of our business. If we look at the breakdown of revenue, though, it provides a useful illustration of the revenue building blocks that the Commerce Commission uses in determining the amount of revenue that Transpower can charge to the users of the grid. Effectively, under the regulatory regime, we receive an allowance for operating expenditure, for depreciation, which allows over time for us to recover the costs of the investment in the grid. For financing costs, and this is to provide the providers of debt capital to the business with a return by way of interest payments for their investment, allowance for tax, and then the residual, the net profit after tax, is effectively the return on shareholders' equity, which then provides the source of underlying dividends going forward. And as Mark mentioned, that's directly a function of the way in which we are regulated and the return that is set by the Commerce Commission. Now looking at capital expenditure. Again, as many of you will know, we've been through a period of very significant reinvestment in the national grid in the last few years. The capital expenditure profile peaked in 2011-12, where we spent over $900 million in that year. And shown separately here is the contribution from those three very large projects that Mark referred to earlier, which together account for about $2 billion of our spend over the past few years, and in fact into this year and the next. In 2012-13, we spent $684 million, and a fair chunk of that was completing at least Pole 3, part of the HVDC upgrade, and completion of the North Island grid upgrade. And then looking forward, if we look at the forecast of capital expenditure as set out in our statement of corporate intent, this year we'll see the conclusion of the Narn project, CapEx continuing to fall and starting to level off at somewhere between $300 and $400 million going forward based on our current projections. Of course, as a consequence of all that capital expenditure, we've seen a substantial and significant growth in our transmission asset base. And as Mark mentioned, that's been the driver for increasing transmission revenue over recent years. We just look at the historical trend first of all. You can see with the line there is showing the increase in transmission assets, around $4 billion at the end of 12-13. And following that trend, increases in transmission revenue, which have got sharper in the last year or so as these major projects have been commissioned. Again, based on our forecast for regulated revenue, at least the latest ones that we have, we would expect that trend next year to continue, but then to see a substantial flattening off in the revenue profile going forward as the major projects are completed. So financial performance has been largely driven by that increasing revenue. We have, however, also seen a widening of our operating margin, that is percentage of EBITDA to revenue. Perhaps not surprising for a capital-intensive business with a lot of investment in recent years. And the challenge for us now is to hold on to those gains in margin that we've made in the last few years and find ways to improve productivity and efficiency in the business to maintain those margins going forward. On the theme of efficiency, obviously financing costs are a significant part of our cost base. In cash terms now, our annual interest bill is around $200 million and will grow further. At the end of 12-13, we had about $2.9 billion of debt outstanding. Importantly, one of the ways we look to maximise the efficiency of our borrowings is to maintain diversity in our funding sources. So the graph here shows the general spread of our current debt portfolio, split between the New Zealand domestic market, US private placement market, and then, and apologies for the jargon here, under our EMTN program, that's European Medium Term Note, borrowings from a range of other markets internationally. By having diversity, it allows us to select markets based on the best available pricing at any particular time. And in conjunction with that, we look to maintain more than one option at any one time so that we're not beholden to a particular market when we look to raise debt. Over the last 12 months, we've raised $450 million, all from the New Zealand domestic market. That's been where the pricing has been most attractive for us, and that's been across a range of maturities between 3 and 15 years. Looking forward, we'll continue to be an active borrower. Over the next couple of years, in each year we expect to raise around $700 million, both to fund ongoing capital investment but also to refinance some of our maturing debt in that period. And finally, on capital structure, as Mark already mentioned, another important source of efficiency for us. Transpower, following the review of our capital structure over the last couple of years, has moved to a level of gearing around 70%. What this graph does is illustrate Transpower against a range of international transmission companies, looking at our level of gearing in the bars against the level of regulated income that that these companies earn, which is shown with the squares there. And typically, transmission companies of this type will have very high levels of regulated revenue, and as you'll see, will operate at similar gearing levels to Transpower. This is about finding the optimum capital structure for us, one which minimises our overall weighted average cost of capital. So just by way of conclusion, so we had very sound financial performance in 2012-13, driven by that increase in our regulatory asset base. We have a sound balance sheet. Capital structure now puts us very much in line with our peers, and we're well positioned for ongoing capital expenditure, albeit now on a declining trend. And importantly, going forward, an increasing emphasis on finding ways to improve the productivity and efficiency of the business, and also optimisation and prioritisation of our capital expenditure program,